Welcome to the unique Forex midweek update for Wednesday, August 3rd, 2016. Okay, so let's get to it. Gonna have a pretty busy week so far. We didn't do a podcast Monday as we were out of the office, and so we're doing it today, Wednesday. It's gonna be a relatively busy week with some interest rate decisions and some other economic news. Obviously, this Friday non-farm payroll is a big one. We're gonna touch base on that in a minute. First, just want to look. We did do a podcast over the weekend, which wrapped up last week, but just want to touch base again, just on the two big events. Was Wednesday, the Fed, they left interest rates unchanged. They remained relatively hawkish, meaning they're looking forward to raising rates in their statements. They were saying the economy is growing moderately, households are strong, employment numbers were strong. Literally the next day, we come to find out pending home sales came in horrible. Home ownership down at 1965 levels, like 50 years lows for home ownership. And then Friday, a huge economic data point, GDP numbers come out, shocks everybody. For the second quarter, grew at only 1.2% when estimates were over 2%. So it grew at only 1.2%. And in fact, the government had to revise the first quarter GDP numbers down lower from their original announcement, down to 0.8%. So the Fed trying to raise rates, obviously can't raise rates for economic reasons. If they want to raise rates for other reasons to normalize them, different story. Now, as far as the Bank of Japan, they came out with interest rate decisions as well. They left rates unchanged. And they left rates unchanged, and the world was expecting them to lower and add massive amount of stimulus. In fact, Ben Bernanke was over there during the week of July 4th, and he is trying to push them to do what's called helicopter money, whether it's in the form of tax rebate or what have you. But they obviously neglected that policy. They added very little stimulus, and the world was not happy with that. As far as this week goes, we did have the Royal Bank of Australia. They did cut rates. That was pretty much expected and known. If they didn't do it, they would have been shocking the world as well. We did have some decent trades. We had a few scalps prior to the Royal Bank of Australia announced its interest rates, and we did have a couple of correlations which we've liquidated this week, which worked out very nicely. In fact, one of them was Aussie dollar correlated with the Kiwi dollar. But since you're correlated, you could take that risk and hold it through those interest rate decision meetings. So we held it. At first went against us, and then within 12 hours or 10 hours or so, completely reversed. We were relatively flat, and then actually last night we were able to liquidate it for a small profit. But we'll take it. It's a profit. Didn't work out as we planned, but that's the beauty of correlation. The actual analysis on the Aussie dollar was what put us in the correlation. We were actually wrong on that, pretty much flat. And the Kiwi dollar we were short was the correlation part of the correlation, which actually worked out in our favor. So let's go back to the economic news so far this week. ISM manufacturing data missed estimates. Is it a surprise? Not really. About 10% of our economy these days, unfortunately, is manufacturing. About 90% is services. Although the analysts do know that, and the analysts have been lowering their estimates for manufacturing, and we keep missing it. So that's not good. Construction spending came in horrible, came in with negative growth, so no growth, obviously, of negative 0.6% when the street was expecting growth of 0.5%. So really bad figures there on construction spending. In fact, that's bringing construction spending down to 5-year lows. We talked about the Royal Bank of Australia. Also, some news that came out yesterday, personal income missed estimates while personal spending beat estimates. Kind of conflicting there, obviously. Personal income growth, that slowed to the lowest level since 2013, even though spending's rising. So households are either dipping into their savings or taking on more credit card risk. Okay, now, Bill Gross came out with a letter last night saying that he says record low bond yields aren't worth the risk, meaning he expects bonds to reverse. What happens today? Of course, bonds continue to rally, coming down not to record lows because we bounced off that level, but moving yields back down. So you got Bill Gross, the Bond King, warning. As a matter of fact, within the article on Bloomberg, which talks about Bill Gross's letter to investors on bonds, they also cited some other pretty big heavyweights within the bond and treasury markets. Now, I was on a business phone call yesterday, and I was actually asked what I think could pop the bubble. Now, we all know we're in a financial bubble, right? You got stock markets up where levels where they shouldn't be, based on fundamental analysis, right? So company sales, earnings, what have you. And it's no secret that we're in a bubble. We're expensive on every valuation method out there. So, of course, I said, I have no idea what's going to pop the bubble. We could wake up any morning, any day, and it could start to pop. And then the street and the talking heads on TV are going to come and they're going to say, well, this is the reason why. Analysts will come out and say this is the reason why. But no one's going to predict it, and I can't predict it either. But what I did say was that I believe central bankers have really painted themselves in a bad corner because 8 years later, after the financial crisis, we've come to find out that zero-bound rates, negative interest rates, and QE just hasn't done what the theory said that they were going to do. Now, we did a big, long podcast on this a little over a week ago about it, wrote a blog post about it, but just want to kind of touch base on it just a hair because that could ultimately be what pops the bubble. And the reason I'm saying that is that the central. Well, first of all, let's go to the Bank of Japan. You had Kuroda. He didn't add stimulus. He didn't cut rates, and he actually came out and he said that he is assigning his staff to look into the effectiveness of zero-bound negative interest rates and QE. And he's saying he's the first central banker to come out and say he doesn't think it actually does what central bankers thought they were going to do as far as zero-bound rates, QE, and negative interest rates. So you have him coming out, right? Now you got Bill Gross saying the bonds yields are not worth the risk, and he's actually saying that zero-bound rates may not be the way to go. So it could ultimately end up being, I'm not saying it's going to be, but it could ultimately end up being that central bankers start to admit that zero-bound rates, negative rates, QE doesn't give the desired outcome, and they may start to normalize rates. There's been a ton of analysis saying that if they start to normalize rates in the United States, for example, for every 1% the Fed raises rates, you're looking at a stock market fall of 20 to 30%. And what does the Fed need to do? The Fed needs to raise rates about 3%, because we're about 1.5% right now to normalize rates. So 2.5 to 3%. Does that mean we're going to go down 60, 70, 80%? Of course not. But if they do normalize rates and they do it on a slow, gradual increase, could we see a total of 20, 30, 40, 50% pullback in the market? Absolutely. So it may ultimately end up being the thing that pops this bubble. Going forward for the week, we've got in about 45 minutes, we've got market services PMI, and in about an hour, we got ISM non-manufacturing PMI. Not that they're huge, but they are some relatively high impact economic announcements. We do have tomorrow, we have Bank of England coming out with an interest rate decision. That's going to be huge. We have Royal Bank of Australia tomorrow, Thursday night, tomorrow night, with their monetary policy statement. Even though they already announced that's going to be like their meeting minutes, I would assume. And then Friday morning is the biggest number of every month, the non-farm payrolls and unemployment numbers. So we'll see what that is. Came out last month in July, much better than expected. The talking heads on TV were ecstatic on CNBC, Bloomberg, Wall Street Journal, how great those numbers were. But if you dive into it, the numbers weren't that great. There were actually more people laid off than jobs created. Yes, they created more jobs than expected, but people being laid off was more. And one of the largest, it wasn't the largest, but one of the largest creators of jobs, once again, was restaurants, entertainment, and notably bartenders, waiters, and waitresses. And the government continues to not create real jobs, not create, relatively high-paying jobs, no manufacturing jobs whatsoever, construction jobs whatsoever, and they're trying to build an economy on the backs of bartenders, waiters, and waitresses. Which, look, let's face it, there's only so many that make a real good living. That work at really expensive restaurants that are very popular, that do a huge amount of business. There are some, I'm not saying all, but the majority of bartenders, waiters, and waitresses, they're getting by. There's certainly not a middle income, upper middle income type job that manufacturing jobs that can create, even construction jobs can create very good living wages. So that's it. We'll do a weekly wrap up at the end of the week. And we'll see if we get any other correlation trades or any other swing trades and whatnot. Maybe we'll do a podcast one day on correlation trade because we know it's very, I don't want to say controversial, but it's very misunderstood by a lot of traders out there, even a lot of investors out there. But it is a great way, correlation trading is a great way to really reduce directional risk. It gives you a lot of different ways, a lot of different opportunities to be profitable with the two positions that you hold, and it involves, instead of just taking a swing trade in a currency pair, which is two economies, two currencies, you're introducing a third economy. Therefore, you're introducing a third currency. So it is a pretty interesting way of managing some money. All right, so that's it. We're going to wrap it up. Enjoy your day. And have a great rest of your day and a great rest of your week.